The risks are still on the horizon, and not everyone is buying into this rally we've seen so far in 2019. What does that tell you?
I think that's a major point. Good morning. Thanks for having us.
Good morning.
I would say this, the results that Steve talked about, as I heard that, was excessively reactive. Excessively reactive. They changed their forecast after the markets went down, right? What about the forecast before, right? And I think the key thing is...
Nothing changes sentiment like price action.
Exactly, but the key thing is this. What I think would happen last year is that we were so concentrated in a few positions, and we're still in the early stages of diversifying our portfolios. And it's showing up in the market because we've seen broad participation. Majority of sectors are doing very well. The cyclical areas of the market are leading the way. We've had a reinvestment in the financials where people have been massively underweight that sector. And so for all intents and purposes, we're seeing a diversification out of the markets. And I would tell you this through my travels around the world is that people missed the move in December. They missed it in January. Now they're bitter. And non-U.S. clients, non-U.S. investors are all of a sudden looking at the U.S. as a home for stability, especially the big move in China. They don't think Chinese stocks can hold these gains. And Europe clearly is going to become the next Japan with no growth, horrible monetary policy, horrible politics. We've got a problem there in terms of spending and growth, and we think that money comes back to the U.S.
You agree? U.S. is the place to be? U.S. stocks specifically, David?
So I think that U.S. equities are probably the safer bet right now. We are late cycle. Let's not forget how many times the Fed has pivoted here and what that's done to markets really since back in October. I think, while the U.S. continues to look attractive, emerging markets are looking much more attractive as well. And, to your point of nothing changes price action like sentiment, when you look at some of the fundamentals there, the currencies still look washed out, but growth is beginning to come back. So we think that there is some long-term opportunity. What I would say about the Fed, and I think that that's really key to what the market has done really since the beginning of this year. The Fed has said that they're going to wait and see. They said that they're going to stay on hold and they're going to be data dependent. It's like when a kid asks their parents in the middle of dinner, "Can I have dessert?" And parents say, "Be patient," right? The parents don't say, "Yes, you can have dessert." They don't say, "No, you can't have dessert." They said, "Be patient and we'll see when mealtime ends." And I think that that's what the Fed has said. And I think markets may be a little bit ahead of themselves at the current juncture.
How is this any different from the celebratory phase we all go into when they do pivot? And we haven't yet taken into account the work they already did in hiking. Well, right, that's the bear argument.
To David's point, we became a Skittles-driven market through QE, right? Give the kids Skittles and let's go. Now we've had the Skittles sugar crash, and now we're coming back to reality. I think the thing that people need to remember, and we have had such a lack, meaning Wall Street has a lack of perspective. I was 5 years into my career in 1995 when the Fed misstepped in late 94 and then entered into a Goldilocks period. A lot of people are talking about Goldilocks. I'm telling you right now, the majority of investors have no clue what Goldilocks is, okay? What happened in 1995 is that foreign investors came back to the U.S. after a conundrum around the globe. U.S. large cap stocks were the home for stability, which David was talking about as well. I think this generation's 1995 is 2019.